Well, interest rates are sitting at an all-time low, but this month Reserve Bank Governor Glenn Stevens said another cut is still on the table. Well, our experts have been second-guessing the governor. So with the new financial year now well underway, we've gone back to see how their predictions on rates from the start of the year are standing up.
I'm very confident the RBA will hit the 1.75 this year, and the reason is the Australian economy is quite clearly slowing. China is also slowing, and at the moment we're just not getting the transition from the mining sector over to the non-mining despite record low interest rates. I think when the next capital spending figures come out, the RBA will be cutting rates in November and they'll close the year at 175.
Back in May, the Reserve Bank cut interest rates as expected by 25 basis points to 2%, as per our prediction. But even with economic growth well below average and the inflation rate well under the target range, there's still little evidence to suggest that the Reserve Bank will cut rates further. This is mainly due to the high property prices we're seeing throughout Sydney and the Australian dollar that is still depreciating. So we think the Reserve Bank will sit on their hands for the rest of the year.
At the start of the year, I was fairly confident that, on balance, the Reserve Bank would continue to hold rates where they are. We've got some forces, excess capacity in the economy, an unemployment rate that's drifted a little lower but not convincingly moving down, that spare capacity in the economy that would argue that there might be scope for a little bit more of an interest rate cut. But on the other hand, we've got particularly the stimulus from the Australian dollar that's going to start flowing through, and we've also got some liquidity from those lower interest rates that's pushing up asset prices. And so that's making the Reserve Bank a little bit hesitant about cutting rates again. So while finally balanced, I think they will actually maintain the 2% rate right through to the end of the year.
We anticipate the cash rate to remain at 2% for the duration of the year. Moderately low inflation indicates that the current position of monetary policy remains appropriate. The recent decline in the value of the Australian dollar has eased pressure on the Reserve Bank to further loosen monetary policy as a means of improving international competitiveness. Indeed, as economic growth remains below trend, expansionary fiscal policy will play the primary role in stimulating the economy as a further cut in interest rates risks increasing already elevated property prices.
I'm very comfortable with that forecast. It's still actually our official forecast at this stage. The Reserve Bank cut twice. We're expecting that. The timing, as always, we didn't quite get the timing right. But as we look at the economy, we're seeing better improvements in terms of particularly the labour market, but also in our business conditions, our confidence surveys. They're all improving at this stage. So whilst you've still got potential problems out there in the global economy, I think the local economy is improving. The housing markets, particularly Sydney, Melbourne, is still very hot.
So with 5 months till the end of the year, all our experts still have a chance of being right. Tomorrow they'll be reflecting on their forecasts on the Australian dollar.